All right, let's talk about home services. You've got your roofers, HVAC techs, landscapers, but there's one industry that nobody really wants to bring up at a dinner party. And guess what? It also happens to be one of the most profitable of them all. Today, we're breaking down the investment thesis for the septic services industry.
You know, this quote really says it all, doesn't it? The fact that nobody wants to deal with it, that unsexy factor, is exactly what creates the opportunity. It's created a market that most people just overlook, which is precisely why the economics are so compelling for anyone willing to actually dig in.
And just how compelling are we talking? Well, for the best operators, the top quartile businesses in this space, we're talking about EBITDA margins between 28 and 35%. I mean, that's a level of profitability you just don't see in other home service industries. So how on earth is that even possible?
Here's how we're going to break it down for you. First, we'll cover why this unsexy business is such a massive opportunity. Then, we'll dive into the numbers, the rock-solid economics behind it. After that, we'll walk through the private equity playbook for scaling these businesses, followed by a super practical due diligence checklist. And finally, we'll get to the good stuff, the returns, and of course, the risks.
So, what's the secret sauce here? What makes this industry's financial foundation so, well, bulletproof? It really boils down to two things: demand that is legally required and absolutely incredible margins on pretty much every single job.
First off, let's get one thing straight. This is not some tiny niche. We're looking at an $8.1 billion industry, and it's growing at nearly 7% a year. But here's the key: it's incredibly fragmented. There are about 7,700 different operators out there, most of them small mom-and-pop shops. And that fragmentation, that's the heart of this whole investment thesis. And here's why that market is so reliable. For the 1 in 5 U.S. households that have a septic system, getting it pumped isn't a choice. It's often required by local regulations. This isn't like deciding to remodel your kitchen. It's a non-negotiable service that has to get done, whether the economy is booming or busting. It's about as recession-resistant as a business can get. Now just look at these numbers. A standard residential pump-out, you're clearing a 60 to 65% gross margin. An emergency call in the middle of the night, that can jump to 75%. Almost every single thing these businesses do is a high-profit machine. I mean, think about it. When a system backs up at 2 in the morning, are you shopping around for the best price? No way. You're just paying whoever can show up and fix it, right now. This chart really puts it all into perspective. When you stack up those 28 to 35% EBITDA margins against other trades like restoration or roofing, it's not even in the same league. It's not just a good business. Financially speaking, it is absolutely best in class.
Okay, so we've established the economics are incredible, but how do you actually capitalize on it? Well, this is where the private equity playbook comes in. It's a proven strategy for buying up these small players, consolidating them, and creating some serious value.
The playbook kicks off with the acquisition, and this is where the real arbitrage is. You see, the entry multiples for these small operators are shockingly low, typically between 2 and 3 times the seller's discretionary earnings, which is just the total cash flow an owner takes home. What's wild is that the multiple often goes down as the company gets a little bigger. This is a golden opportunity to buy profitable assets at a discount before you professionalize them and scale them up to a size that commands a much higher multiple, like 4 to 5 times EBITDA.
And listen, this isn't just a theory. The roll-up is already happening, and it's happening fast. You've got major players backed by serious private equity firms, like Wind River Environmental, with over 100 acquisitions under its belt, actively consolidating this fragmented market. They're proving this playbook works, and it works at scale.
So here's that 4-step strategy in a nutshell. Step 1, buy a small operator at that low multiple. Step 2, immediately bring in some simple tech to optimize routes and lock in recurring revenue. Step 3, add a commercial sales effort to go after those bigger, higher-margin jobs. And Step 4, you exit, selling to a platform buyer at a much higher multiple. It's a proven, rinse-and-repeat formula for creating value.
But look, a great strategy is one thing. Execution is everything. Knowing what to look for before you buy is the difference between a successful deal and an absolute nightmare. So, what should be on your due diligence checklist? First, you have to know where to hunt. The hottest markets are concentrated in the Southeast and the Mid-Atlantic, areas with high septic density, strong population growth, and where PE is already active. Places like Atlanta, Charlotte, and the Raleigh-Durham area are prime hunting grounds. Even in the best markets, though, a deal can go sideways. So how do you protect yourself? Where are the hidden risks that could completely derail this whole thesis? It all comes down to verifying a few key operational details. Okay, before you even think about sending a letter of intent, you need to verify these 5 things. Is the customer database a digital gold mine or just a list in the owner's head? How old are the trucks and are they falling apart? Where does the waste go and what does it cost? Can the business licenses even be transferred? And what's the current revenue mix? The answers to these questions will tell you the true value of the business.
All right, let's get to the bottom line. We've seen the strategy and the execution plan. But what does the financial payoff actually look like? Let's run through a hypothetical deal, and we'll balance the potential returns with an honest look at the risks.
Let's say you find a target doing $1.2 million in revenue with $300,000 in owner's cash flow. At a 2.5x multiple, your purchase price is a nice, round $750,000.
Now here's the best part. Because this is a profitable, cash-flowing business, you can finance this deal. With an SBA 7A loan, your actual equity injection, the cash out of your pocket, could be as low as $112,000. This makes the acquisition remarkably accessible.
So after you implement that value creation playbook for a few years, adding recurring revenue and a commercial sales mix, you boost the business's EBITDA to over $400,000. When you sell to a platform buyer at a 4.0x multiple, your exit valuation is a cool $1.6 million.
That exit is more than double what you paid, and when you factor in your low initial equity and the cash flow you generated along the way, the internal rate of return on this hypothetical deal is a staggering 42%.
But of course, no investment is without risk. While the fundamentals here are incredibly strong, you have to be aware of the challenges. Fuel and disposal costs can be volatile. In some areas, sewer expansion can shrink your market. And the labor is, without a doubt, physically demanding. You have to weigh these operational risks against the powerful, built-in advantages.
So let's bring it all together. The investment thesis is beautifully simple. You buy low-multiple, fragmented assets, you apply a straightforward playbook of technology and sales improvements, and then you sell that improved, de-risked asset to strategic acquirers who are willing to pay a premium for scale.
Which leads us with a final question. In the entire landscape of home services, this is the industry where the profit margins are the highest and the entry multiples are the lowest. Yeah, the work isn't glamorous, but for an investor focused purely on the numbers, are these economics simply too good to ignore?